Hello everyone, and welcome to this next video in my YouTube trading training course. In this one, we're going to go ahead and look at a really big topic for most traders, both new and experienced in the markets, and that's indicators. Because at the end of the day, indicators are a very important tool in your trading, and they always should be, because when they're used the right way, they become really helpful and they will grow your trading accuracy and lead to more profit. And that's essentially what you're after as a trader. So let's go ahead and let's get into it. So indicators and reading price, because really what indicators do is they help us read price over time, because they enable us to know where the market is at any time. And that's their real use. We're not looking for lineup tactics where everything's in line. We just want to gauge the value of price, whether it's high or low. So of course, as you know, I advocate a lot of the time to buying low and selling high. So really it works all in one. Okay, so this is the right way to use indicators. So why use indicators? So indicators, they're basically based on averages of price and they're illustrated in various ways. And some are delivered as market strength, like the RSI, and some just show how overbought or oversold an asset is in question. So they're supposed to keep a constant gauge of the market, and a lot of traders, they don't use it for this reason. They use all their indicators for a lineup theory, and you will have heard me speak about that before, and that basically just means that traders are looking for indicators to all line up before they press buy or sell, and it's not actually the best way to use them. The best way really to use them is to gauge price at all times. So the way we can really look at this in detail is by taking an example outside of the markets. And for example, when temperatures are recorded, you often see a moving average line. And that basically helps you keep track of what's a normal value and what isn't. And any deviation between that obviously tells you what would be a high temperature and what would be a low temperature. Now, when people start to use moving averages in the markets, if they do use them, or any indicator, they completely throw that out the window because they stop using them for that reason. So we need to use indicators to measure what is a low and what's a high price over time, just like any other indicator would be used in any other scenario. Okay, so it's no different to recording temperatures or recording sales or anything like that. We just need to know what's a high value and what's a low value because we want to trade in line with that at all times. So indicators and their real use. So indicators, they're best used as a gauge of the value of price over time, as I mentioned. We're really going to need to know what is a low price and what is a high price, and that needs to be the core of our plan because that will allow us to be successful in the markets. And you know, instead of us having to average out price constantly, we can just get a computer to do it. And that's really what things like moving averages and any indicator really does. It just takes data from price chart and averages it out to show us a value over time illustrated on a chart. So that's going to show us is price high and or is price low. And we need to know that at all times. And therefore we can make profit over time because we're using our indicators properly to buy low and sell high. So how not to use indicators? This is a part which I thought would be really helpful to put in because it will really clear up anything when you're picking your indicators or how to use them over what period. So lots of traders, when they come into the market, they might learn from other traders and they'll sort of flood their chart with indicators because they really think it's the best thing to do. And unfortunately, it just isn't. And actually, paradoxically, it causes a bigger problem because it makes the charts more messy and you can't see price clearly at all. Okay, so it will then give you incorrect readings. It will lead you to believing in incorrect hope of where price is going. And you just don't want that because it's going to cost you money. And obviously, you don't want to lose money as a trader. Your goal is to make money consistently. So you don't want to be waiting for indicators to line up. As I mentioned, you'll hear me say that a lot. And it's because new traders, when they come into the market, they think it's a magical concoction. And they really look for things just to all be in line at a certain point before they hit buy and sell. And that's just the wrong approach. And it often leads to lots of losses. And the reason for that is because that's just not how the markets work. It's not based on lineups. It's based on accumulating your positions at prices that have value, whether they're low or high. And also on that as well, lots of traders, they think that when something is overbought or oversold, there's no way price can keep going that way. And when you believe that, it just really doesn't work, because you're then going to lose money when you put your positions in. And even some traders, they up their risk, which is really not a good idea, especially in those situations, because price can keep going against you. So don't use indicators as a hard line thing. You're not looking for lineups, and you're not looking for the ultimatum of price. Price can keep moving. So lineup theory on indicators and waiting for them all to be in line just doesn't work. So both those factors, they really represent how indicators are used the wrong way, and obviously you can use that information to use them the right way, and that's what I hope this video will really help you with. So a lot of the time as well, people ask, how many indicators should I use? And again, when they enter the markets, they flood their charts of indicators, and it really becomes a problem, because they then have too many, or they think they have too little, and they get a bit confused. So there's good reason for that, and lots of traders, they're taught that more indicators means more profit, and it's just not true. So as a maximum and a general rule, it's a fair amount of indicators is 2 or 3, just to keep your charts clear and give you exactly what information you need. Remember, that's knowing what's a low price, what's a high price, so you can buy and sell in line with the market. And it's absolutely not necessary to flood your charts of indicators so much that you can't see what you're doing, because really, as I say, that's going to cause you lots of problems, and therefore more is less, because if you're flooding your chart, you really won't be able to see what you're doing, and you don't want that. And you'll also get a lot of contradiction in your decisions, because you'll be seeing one indicates like this, one indicates like that. There's divergence. Should I buy? Should I sell? And it really makes you miss those key trades you need to be taking. So after all, what we're really looking for is a way of looking at the markets with a degree of certainty, and something that really guides us at all times, so we know what value price is. And that's the power of having a clear lens, or looking at the markets clearly. So using the correct indicators with the correct method is simply the best way to trade. And that's exactly what we do in my trading academy. We use the right ones for the right reason. I've got a whole load of videos on that. But to put it simply, you want to use them as a continuous gauge of price. We're not using any hard line methods, so that means waiting for everything to line up before you hit entry, and having those overbought and oversold prices, meaning that's final, and your trade will just go in the right way you want when you enter it. It just doesn't work like that, and it's really dangerous to trade like that as well. So we want to accumulate price. We want to accumulate positions as price falls or rises, and that's because we want to buy low and sell high. And we know we're not trading with a hard line. Price can keep moving in the way that we might not want it to go, but we know we can adjust our risk, and we can trade accurately and have a high trading success. So the core principle really is buying low and selling high, and using indicators the right way lets you do that. And you won't be looking for a hard line method. That's really what you need to understand, and that's what you should take away from this video. So use indicators as a gauge for low and high prices, and make your decisions when trading with that. So thanks for watching, guys. This is another video in my YouTube training series. I'm going to be posting more of these, so make sure you like and subscribe. And if you're interested in learning to trade the right way and being profitable, go ahead and visit my website. I've left a link to it in the bio.